In the heart of New York's financial district lies Wall Street, a narrow street that grew into the symbol of global capitalism. Behind its historic buildings and flashing digital tickers stands the powerful New York Stock Exchange, a place where fortunes are made and lost in seconds. But Wall Street is more than just a location. It represents ambition, risk, power, greed, innovation, and sometimes collapse. To understand the rise and fall of Wall Street is to understand the story of modern America itself. Wall Street's journey began in the late 18th century when a small group of traders signed the Buttonwood Agreement in 1792, creating an organized securities market. What started as a handful of brokers trading government bonds slowly evolved into the largest financial marketplace in the world. As America industrialized in the 19th century, railroads, steel companies, and oil giants raised money through Wall Street, turning it into the engine of economic expansion. Investors saw opportunity everywhere, and speculation became part of the culture. The 1920s marked one of the first dramatic rises and falls. Known as the Roaring Twenties, it was a time of booming stocks and widespread optimism. Ordinary Americans poured their savings into the market, often buying shares on margin, borrowing money to invest. Stock prices soared beyond realistic values. Then in October 1929, panic struck. The market crashed, wiping out billions of dollars in days. The Great Depression followed, proving that unchecked speculation could destroy not just wealth, but entire economies. After World War II, Wall Street rose again. America became a global superpower, and its financial markets grew stronger than ever. New regulations were introduced to prevent another 1929-style collapse, restoring public trust. The second half of the 20th century saw the rise of corporate giants, mutual funds, and eventually electronic trading. The financial world became faster, more complex, and more interconnected. Wall Street was no longer just American. It influenced markets across the globe. By the early 2000s, financial innovation reached new heights. Complex instruments like mortgage-backed securities and derivatives promised high returns with seemingly low risk. Banks approved risky home loans, and housing prices skyrocketed. For a while, it looked like endless growth. But beneath the surface, cracks were forming. When homeowners began defaulting on loans, the system unraveled. In 2008, major institutions collapsed, markets crashed, and panic spread worldwide. The crisis exposed how fragile even the most powerful financial systems could be. Yet once again, Wall Street survived. Governments stepped in with massive bailouts, regulations tightened. Technology transformed trading into a high-speed digital battlefield, where algorithms execute deals in milliseconds. Today, retail investors trade from smartphones, hedge funds manage trillions, and global markets react instantly to political or economic news. Wall Street remains powerful, but it also faces criticism for inequality, corporate influence, and the growing gap between the wealthy and ordinary citizens. The story of Wall Street is a cycle of ambition and correction, risk and regulation, rise and crash. It fuels innovation, funds businesses, and drives economic growth. But it also reminds us that markets are built on human emotion. Fear and greed often matter as much as logic and data. Every bull market carries the shadow of a potential downturn. Every crash plants the seeds of recovery. In the end, Wall Street is not just about money. It is about belief. The belief that tomorrow will be better than today, that risk can lead to reward, and that even after the darkest financial storm, recovery is possible. The rise and fall of Wall Street is a reflection of human nature itself, constantly balancing between confidence and caution, expansion and collapse. And as history shows, the cycle is far from over.